Welcome. Today we're taking a deep dive into the 9-month financial performance of Doğan Şirketler Grubu Holding AG.
You'll see it on the Borsa Istanbul under the ticker DOHL.
And our mission here is pretty crucial. We want to take their interim report, which is dense, multi-sector, and frankly, really complicated.
Especially with the high inflation environment.
Exactly. And we're going to transform it into clear, digestible, and most importantly, actionable insights for you, the thoughtful retail investor.
This specific deep dive requires a lot of focus. We are working exclusively from their interim report, which covers the period from January 1st to September 30th, 2025.
And for anyone tracking global holding companies, this kind of report is a real challenge.
It is. It's prepared under the very stringent standards of the Capital Markets Board, the SPK. But the key thing, the thing you have to watch, is that it uses high inflation accounting rules.
TMS 29.
That's the one.
That acronym, TMS 29, is going to be central to our discussion today because it doesn't just restate figures, does it? It fundamentally changes the narrative.
It completely changes the narrative. TMS 29 restates all figures to the purchasing power of the reporting date, in this case, September 30th, 2025.
Which means?
Which means a headline, net loss, might not reflect operational reality at all. It could just be a huge non-cash accounting adjustment.
So we have to separate the real business from the accounting noise.
Precisely. We have to dissect the corporate structure, scrutinize the big strategic moves, the asset sales, the huge investments, and then analyze the key numbers that tell the real story of the group's portfolio. We're separating the operational wheat from the accounting chaff.
And as we navigate all this complexity, please remember, if you find this analysis helpful, hit that like button, subscribe to our channel for more deep dives like this, and share this content with others.
Your engagement really does help us decide which complex reports to tackle next.
Okay, let's first get to know the company a little. Before we dissect the financials, I think we need a complete picture of Doğan's identity, its scale, and its reach.
Right. Doğan Holding is a legacy name in the Turkish business world. It was established way back on September 22nd, 1980.
And they're headquartered in Istanbul.
Yes, firmly rooted there. Üsküdar, Istanbul, to be specific. But while they have this very strong domestic anchor, their business model is anything but local.
So what exactly is their business model? Because when you look at their subsidiaries, they seem to be everywhere. Energy, used cars, digital real estate.
Yeah.
It's a huge mix.
And that lack of specialization is, in a way, their specialization. Doğan Holding is explicitly a non-manufacturing holding company.
Meaning they don't make stuff themselves.
Exactly. They don't dig the copper out of the ground directly or generate the wind power on their own books. Their core activity is actually capital allocation and strategic portfolio management.
So they're like a giant investment firm.
A massive, actively managed mutual fund, but with total operational control over their holdings. They invest in a highly diversified stack of different sectors through subsidiaries, and they provide strategic governance, capital, and oversight to maximize returns across the whole group.
That idea, a huge portfolio manager, that's crucial for understanding their current strategy, right? The whole simplification thing we'll get to later.
It's central to it.
Okay, so in terms of sheer size and stability, let's look at their capital structure.
Well, they have a deep history in the public markets. They've been trading on the Borsa Istanbul as Dual since June of 1993.
A long time.
A very long time. Their issued capital right now stands at about 2.6 billion Turkish liras, which is set comfortably against a registered capital ceiling of 4 billion.
Which means they have room to raise more capital if they need it.
They have significant headroom, yes, though their current strategy seems more focused on generating capital internally and recycling assets.
What about their physical scale, employment numbers? That gives us a ground-level view of their impact.
As of the end of September 2025, the group employed 7,282 people globally.
And most of them are in Turkey.
The vast majority, 6,895, are based in Turkey. But what's interesting is that this is actually a slight reduction from the end of 2024, when they had 7,659 employees.
A drop of a few hundred people. Is that a bad sign?
Not necessarily. When you pair it with their strategic focus on simplification, it suggests they're actively streamlining, maybe optimizing the workforce in non-core areas, or shedding staff from the businesses they recently sold. It hints more at consolidation than pure contraction.
Okay, let's unpack that diversification because for a retail investor, that's their first line of defense against domestic economic shocks. Where are their big bets?
The group operates across 7 distinct business sectors. It's a structure that requires very sophisticated management, but it offers a lot of stability.
What are the big ones?
The key sectors are first, electric production, which is dominated by Galata Wind, their renewable energy flagship.
Okay.
Then there's mining with Gümüştaş Madencilik, which is becoming a really important high-margin business for them. Third is finance and investment, which houses their investment bank, and the disruptive digital insurer Happy Sigorta.
Happy has been a big growth story.
A huge one. Then you have industry and trade with companies like Carroll in telecom and defense and Sesa Emballage in packaging.
Right.
Fifth is automotive trade and marketing, centered on Dozan Trend Automotive, which distributes brands like Suzuki. Then internet and entertainment, so things like Canal di Romania and the online real estate platform Hepsi Emlak.
And finally, real estate.
And finally, real estate investments through D. Geruminkel and Milta Tourism.
That portfolio is incredibly complex. So how does their international presence fit in with all this? Because this isn't just a Turkish company.
Absolutely not. And their global footprint is strategically vital for hedging against currency and inflation risk. The international subsidiaries are often tied directly to their biggest growth engines, especially renewables.
So the push into Europe, for example,
Is all about green energy. They have major subsidiaries in Holland, and they're making aggressive new expansions into Germany with Sunspark and Italy with Solavento investments. These aren't random. They directly support Galata Wind's goal of getting 300 megawatts of international capacity by 2027.
and outside of energy.
They still have significant media and telecom operations in Romania, like Canal D. And then in Asia, they have a substantial industrial presence through multiple Daiichi subsidiaries in China, plus growing operations in Uzbekistan and India.
They're really all over the map.
They even have niche presences in places like the US and Jersey. It shows a very deliberate global strategy to balance their portfolio away from just domestic economic pressures.
So the key takeaway isn't just that they have a lot of locations, it's that the international spots are strategically supporting their highest growth, highest margin businesses like renewables and tech.
That's the core idea.
Let's pivot to governance. Given the size and legacy of this company, we have to look at who's actually in control, and this is clearly a family-controlled entity.
It is, and that concentration of control is a defining feature of D-Hall. The Aydin Doğan family members collectively hold a dominant 63.64% stake.
Which means they set the direction.
It ensures a stable long-term strategic direction, but it also means retail investors have to place a lot of trust in the family's vision and governance.
And the free float, the part available for public trading.
Stands at 35.86% as of the end of September.
We also saw some big leadership changes in this period right at the top.
We did. There was a notable shift at the head of the board. Hanzade V. Dozan Boyner took over as board chair in April, succeeding Begumhan Dozan Feryala. Vuslat Sabansha continues as vice chairman.
So continuity within the family, but new leadership at the helm.
Right, which signals they're actively engaged with this new roadmap of simplification and growth.
And what about modern corporate standards? Diversity in governance is a huge focus globally.
Yeah.
How does Doğan's board stack up, particularly on gender ratio?
Actually, pretty well. The board shows a commitment that often exceeds regional averages. Out of 12 total board members, 4 are female directors, Hanzade, Vuslat, Arzuhan, and Begumhan. Plus, they have Ayşegül Ildeniz as an independent member.
So that's 5 women on the board.
Oh, right, 5 total. My apologies. Which makes it about, over 40%? A very strong representation.
That's a significant point for investors who prioritize strong ESG governance standards.
It is.
And finally, executive compensation. How transparent are they here?
It's handled through a pretty explicit policy. The structure is based on equal pay for equal work, benchmarked against the market, and importantly, it's directly linked to clear performance metrics.
And who oversees this?
The Corporate Governance Committee sets it, and the policy is presented and approved by the General Assembly, so there's shareholder oversight. They also take specific measures to ensure the pay for independent board members preserves their independence, which is vital in a company with such concentrated ownership. What's really fascinating here is that Doğan is moving beyond just being a big, diversified Turkish company. It's defining itself as a global portfolio manager, strategically betting on high-margin, future-focused sectors like renewable energy and digital finance.
Okay, so let's look at how they're stacking up in these varied markets and analyze their strategic health based on this 9-month data. We know the strategic goal is focus, simplification, and resilience. But how is management actually achieving that value creation in what's been a very tough regulatory environment in some of their sectors?
The CEO's commentary is really clear on this. They're executing strategic value creation initiatives focused on portfolio simplification. The whole aim is to shift from a sprawling conglomerate to a more resilient and balanced profit profile, where no single sector can dominate the group's fortunes.
And you can see that in the asset sales.
Absolutely. They're shedding lower margin or high liability assets to focus capital on faster growing, higher margin businesses.
And we can see this strategy bearing fruit in specific segments. Let's start with digital finance, which has been an exceptional growth story.
The performance of Hepay is a prime example of successful digital disruption. I mean, its growth has been explosive.
They really shot up the ranks, haven't they?
They have. As of September, it's now Turkey's sixth largest mandatory traffic insurer and the eighth largest for Casco, or comprehensive auto insurance.
And to put that growth into perspective,
Their Casco market share jumped by 143 basis points to 4.2%. In a mature market like insurance, getting that much penetration in just 9 months speaks directly to how efficient and scalable their digital model is.
meanwhile, their heavy industry and energy assets are providing a solid, stabilizing foundation.
Yeah.
That's crucial when other sectors are facing challenges.
You see rock-solid operational resilience there. Gümüştaş Madencilik, their mining arm, had exceptional performance. This was driven by a 26% increase in production, combined with favorable prices for lead and copper.
A perfect combination.
It is. Good prices plus better efficiency equals high margin stability. And similarly with Galata Wind, their energy business, which saw a massive 44% increase in Q3 electricity production year on year.
A mix of new capacity and good weather, I assume.
Exactly. These two sectors are essential for predictable, high-margin EBITDA generation.
Okay, here's where it gets complicated for the headline numbers. The challenging segments. The automotive business. I get the strategy to manage inventory risk, but a 66% plunge in Q3 revenue looks disastrous on paper.
It does. And that is the central operational dilemma of this report. Dozan Trend Automotive was hit hard by new regulations, specifically high import tariffs on vehicles from China.
So management made a tough call,
A very calculated, deliberate decision. Instead of loading up on expensive inventory that might not sell, they adopted a radical minimum stock policy.
which killed their sales numbers.
It instantly crushed Q3 sales volumes, leading to that 66% plunge in revenue. It was a choice to protect the balance sheet and manage liquidity risk at the expense of immediate market share and revenue.
The big question is whether they can get that market share back once things normalize.
That's the long-term gamble.
So, given all these moving pieces, the digital success, the energy stability, and that automotive drag, how do we structure what Dole is good at right now versus what's holding them back? Let's use a SWOT framework based on this 9-month data.
Good idea. Starting with strengths, the data really highlights 3 pillars. First is what I'd call diversification with balance. The CEO confirmed that every single main business line now contributes meaningfully to consolidated EBITDA. This balance is a huge strength. It means the drag from the automotive sector, while damaging, doesn't cripple the whole group.
Okay, strength number 1, what's 2?
Second, an exceptional cash position. Even after paying out big dividends and injecting capital, the holding's solo net cash position stood at a very robust $617 million.
That's a lot of flexibility.
Immense financial flexibility. And third, proven growth engines. The successes in renewable energy, mining, and digital finance aren't just ideas. They're proven, high-margin, scalable businesses.
Okay, moving to weaknesses, W. What are the clear vulnerabilities we can see in this 9-month snapshot?
The most immediate one, and the one that will dominate headlines, is the consolidated net loss of 384 million Turkish lira.
That reversal from profit to loss is a big deal for investor perception.
It's a major weakness, even if it is driven by accounting. Secondly, the severe sectoral drag from the automotive segment. It's a tangible weight, shown by that negative 66% Q3 revenue decline. Management is controlling it, but the numbers just look bad.
And the third weakness?
Lastly, operating in that extreme high inflation environment. It forces them to use TMS 29, which constantly restates figures, complicates analysis, and generates that enormous non-cash monetary loss that distorts the net result.
Now for the upside, opportunities.
Hmm.
Where does their strategy give them the most room to run?
The biggest opportunity is global expansion in energy. Galata Wind is executing an aggressive international strategy, explicitly targeting 300 megawatts of capacity abroad by 2027. The acquisitions in Italy and Germany are proof of that.
Okay, what else?
Secondly, there's the digital scaling advantage. Happy Segura's digital platform has an incredibly low expense-to-income ratio of just 2.8%. The sector average is 7.0%.
That's a huge efficiency gap.
It means they can scale far faster and cheaper than traditional insurance models. And finally, the ongoing portfolio optimization. Selling assets like Ditosh and Boyabat generates cash that can be immediately redeployed into these high-growth opportunities.
And to round out the SWOT, the threats. T. What risks are systemic and mostly out of their control?
The primary systemic threat remains regulatory risk. The automotive import tariffs showed how government rules can instantly erode revenue and force a major strategic pivot. That uncertainty is constant.
And that's tied to the broader economic picture.
Tightly linked to currency and inflation risk. They operate across many currencies, so exchange rate fluctuations are a big deal. And critically, sustained high inflation in Turkey will continue to generate those monetary losses, making any kind of forecasting highly volatile.
Now we can move on to our analysis. This is where we break down the complex numbers for you, comparing this 9-month period to last year and trying to filter out that accounting noise to find the real operational story.
All right, let's start at the top line revenue. For a retail investor, the headline figure here is pretty concerning.
It is. Total consolidated revenue dropped 15% year-on-year. It fell from 78.8 billion lira to 67.0 billion. That looks alarming.
It does, but we have to apply that critical filter we talked about. We have to factor in the deliberate contraction of the automotive business.
That context is everything here, isn't it?
It is absolutely essential. If we apply that filter and exclude those on Trend Automotive, the underlying revenue story completely reverses.
It goes up.
The remaining core revenue actually increased by 9%. It went from 50.1 billion lira to 54.7 billion.
Wow. So the automotive business was masking healthy growth everywhere else.
Entirely.
Right.
The planned sales decline in AutoWide, a massive 57% drop for them over 9 months, completely hid a high single-digit underlying growth across the rest of the group. The restructuring is working even if the headline number screams contraction.
That's a crucial distinction. Okay, so the core business is growing. Now let's look further down the income statement. What about gross profit and margins? Did the cost management pay off?
Yes, significantly. Gross profit increased by a substantial 22%. It rose from 9.17 billion to 11.23 billion lira.
And this happened even with lower overall revenue.
Exactly. Which confirms much better cost management and stronger margin performance, especially in those high-margin drivers we identified, like mining and energy. They're selling less overall, but what they are selling is much more profitable.
And how about EBITDA, or FAVOK, the metric that shows pure operating cash flow?
Consolidated FAVOK grew robustly by 59%, jumping from 4.49 billion to 7.12 billion lira. This shows profound operational momentum.
So the margin expanded nicely.
Substantially. The FAVOK margin improved by 4.9 percentage points, hitting 10.6% compared to 5.7% last year. This is where the strength of the portfolio really shines.
And if we look through that automotive lens one more time, how strong is the cash flow without that drag?
Without Trendoto, it's even more pronounced. A 52% increase in FAVOK, and the margin improvement brings it to a very healthy 13.8%. This proves the core strategic segments are generating significantly more operational cash.
This leads us to the core operating profit, the ISAS Feliet Kari. The report shows this hitting 8.7 billion lira, which is almost double the 4.58 billion from last year. That's a huge jump.
And that jump provides the necessary context for the net loss we're about to discuss. That growth in core operating profit is the result of 3 things converging.
Okay.
First, those improved margins in energy and mining. Second, the winding down of major restructuring expenses and turnaround businesses like Carroll. And third, a big volume of other operating income, about 9.2 billion lira, which comes from things like gains on asset sales.
This brings us to the moment of reconciliation, the net profit or loss. We've just seen stellar operational figures, massive growth in EBITDA and operating profit. Yet the group recorded a net loss of 384 million lira.
A huge reversal from the 4 billion lira profit last year.
For an investor, this is incredibly confusing. Why the massive disconnect?
This is the absolute crux of our deep dive. The narrative challenge for Doğan is bridging the gap between their strong operational health and this headline, net loss. And the answer lies almost entirely in two massive non-operational factors that distort the final result.
Let's start with the one we identified early on, that high inflation accounting.
The biggest distortion is the monetary loss from applying TMS 29. In the first 9 months of 2025, the group reported a massive non-cash monetary loss of 4.69 billion lira.
Then what was it last year?
Now compare that to last year, which reported a monetary gain of 1.33 billion lira.
So that's a 6 billion lira swing.
A 6 billion lira swing from a gain to a monumental loss. It's a non-cash accounting adjustment reflecting the erosion of purchasing power. It hits the balance sheet, but it doesn't represent cash spent or lost in operations.
So the monetary loss is like a 6 billion lira accounting anchor, dragging down the result no matter how well the wind farm performs. What's the second factor?
It's the sharp increase in net financing expenses. The rise in Turkish interest rates drove a massive net financing expense of 8.7 billion lira.
Wow, 8.7 billion.
So even with excellent operational profits, having financing expenses equal to your core operating profit means you are essentially running in place before that monetary adjustment even hits.
So you start with 8.7 billion in operating profit, subtract 8.7 billion in financing costs, and then get hit with a 4.7 billion monetary loss.
And the final negative net result becomes entirely understandable, even mathematically necessary. The net loss is a measure of the financial environment and accounting standards, not a reflection of core business failure.
Since the consolidated numbers are so heavily distorted, let's focus on the raw operational drivers. What are the individual segments telling us?
We'll start with the biggest operational cash generator, renewable energy, Kalata Wind. This is an anchor for their stability.
And their Q3 was explosive.
It was. Electricity production soared 44% year-on-year, a combination of good weather and new capacity coming online. While the 9-month revenue was flat, Q3 revenue showed strong momentum, up 15%.
And the margin performance is what really defines this segment's value.
Absolutely. The operational margins are elite and highly predictable. The FAVOK margin stayed strong at 70% in Q3, which is right at the high end of management's expectations. For an investor, that predictability is invaluable.
Okay, next up, mining. We can't compare year on year here, but the 9-month performance looks exceptional. What's driving that?
The mining segment is quickly becoming a critical high-margin asset. Production increased 26% over 9 months. They reported strong revenue of 1.38 billion lira and a FAVK of 538 million, which gives them an outstanding 39% FAVK margin.
So they're hitting their targets there.
They are. It's a result of better efficiency and favorable global prices for lead and copper. This 39% margin shows it's a great complement to the energy portfolio.
Shifting to digital financial services, Hepai Sigorta. The story here is all about technological efficiency, right?
It's defined by scale and leverage. Their managed portfolio size reached nearly $700 million, showing robust 60% annual growth. Gross written premium was up 57% over 9 months.
But the efficiency is the key.
Because of its fully digital infrastructure, its net profit, non-TMS 29 adjusted, was up 51% in Q3. And think about this. Their expense-to-income ratio is just 2.8%.
Compared to what for the sector?
The traditional sector average is 7.0%. In an industry known for huge overhead, that 2.8% figure isn't just good, it's potentially revolutionary for their scaling ability.
The industry and trade segment, Carroll and Sesa Emballage, showed critical operational turnarounds in Q3. This is where strategic cleanup really paid off.
Yes. Carroll had a necessary turnaround, posting a plus 10% FAVK margin, a huge swing from the loss it recorded in Q3 last year. This is largely because major restructuring expenses are finally winding down.
And there was a standout detail there.
The defense segment. Its gross margin leaped from 26% to 54%. Doubling profitability in defense is strategically huge. It signals a successful pivot to higher value manufacturing.
And Sesa Emballage proved resilient.
Sesa's story is about pricing discipline in exports. Even though revenue dipped slightly, disciplined pricing boosted its FAVK by 135%, raising the margin from 6% to 16%. And crucially, its U.S. export share rose from 15% to 19%.
So they're locking in dollar revenue,
which shields them from domestic volatility.
Finally, the automotive segment. We know the pain points, but what about the balance sheet management during this crisis? That's a silver lining.
The Q3 revenue plunged 66%, yes. But management's focus shifted entirely to liquidity. By running down inventory instead of buying expensive tariff-hit stock, The company successfully cut its net debt from $162 million at the start of the year to $75 million.
So they managed liquidity extremely well.
They did, and they had one bright spot. Suzuki passenger car sales grew 77% in Q3 due to effective promotions, which shows demand is there when the supply chain is managed right.
Now let's move to the balance sheet health and capital management. We need to trace those strategic investments and asset sales through the net debt, cash flow, and equity.
Starting with cash, we saw a massive nominal reduction. Cash and equivalents dropped from 32.4 billion lira at the end of 2024 to just 11.6 billion in September.
That looks like a major cash crunch on the surface.
It does.
Okay, let's unpack this. A 20 billion lira drop in cash. Where did that capital go, and was it planned?
It was entirely planned and largely strategic. The holding's solo net cash position fell from $662 million to $617 million. So the cash wasn't lost, it was deployed.
Deployed where?
The main outflows were substantial. First, an 800 million lira dividend payment to shareholders. And second, capital injections, most notably the 682.5 million lira into their investment bank to maintain their stake during a capital increase. These are proactive, strategic uses of cash.
Okay, let's talk debt. This is another major point of confusion. Total financial borrowings actually decreased.
That's right. They went down from 34.1 billion to 27.8 billion lira. That's a positive. They reduced total outstanding borrowings by several billion. But when we look at consolidated net financial debt, which is borrowings minus cash, that figure increased significantly. It jumped from 5.85 billion to 18.39 billion lira.
That is a staggering spike in net debt, over 200%. How do we reconcile falling total borrowings with a huge increase in net debt? This could cause panic for an investor.
This anomaly is the result of linking three factors, and it requires careful explanation.
Okay, step one.
Step one, the cash reduction. The main driver is that 20 billion lira reduction in cash we just discussed. Since net debt is debt minus cash, when the cash offset drops dramatically, the net debt figure automatically goes up, even if absolute debt is shrinking.
Okay, that makes sense.
Step two, inflation accounting. TMS 29 further complicates this by restating monetary liabilities, including debt, to the current purchasing power. This tends to inflate the nominal value of borrowings on the balance sheet, which widens the gap and increases the reported net debt.
So what's the final interpretation?
The company is actively spending its cash reserves on growth and dividends while slightly reducing its gross borrowing. The spike in net debt is primarily an accounting and capital deployment signal, not a debt crisis. They're choosing to prioritize high-return investments over just holding cash.
What about shareholders' equity? This gives us the final measure of capitalization health.
Shareholders' equity saw a slight decrease from about 79.5 billion to 78.1 billion lira. This is negligible given the scale and reflects the absorption of that non-cash monetary loss.
But the overall position is still strong.
Critically, equity remains very strong. It represents 46% of total assets. The group maintains a very healthy and conservative capitalization ratio, and their paid-in capital of 2.6 billion lira is well below their 4 billion ceiling, confirming they have room to maneuver.
The strategic activities in these 9 months perfectly illustrate that simplification and focus strategy you mentioned.
They do. It involves simultaneous exits from non-core assets and aggressive investment in their growth engines.
Let's start with the simplification side. The exits.
The first major step was the DTOS sale. They sold their stake in DTOS, a steering and suspension systems company, for $14.5 million.
And this was more than just a simple sale.
It was a complex portfolio cleanup. It allowed them to collect over 114 million lira in capital advances, and crucially, it canceled a previous commitment related to a public offering for DTOS. It cleaned up their corporate structure and freed up management's focus.
The second sale, Boyabat, was tiny in price, but strategically huge for liability reduction.
Exactly. They sold their share in Boyabat Electric for a nominal 1 lira. Why? Because that sale removed the holding's massive $33 million guarantee obligation related to that company's refinancing loans.
So they got rid of a huge contingent risk.
For a negligible cost. It shows management prioritizing risk reduction over nominal sales proceeds.
And on the other side of the ledger, aggressive growth investments, especially in renewables, cementing that 300 MW international target.
Solana Wind made significant international acquisitions to accelerate their diversification into Europe. They bought projects in Germany, including a 22 MW agri PV and a battery unit, expanding their target capacity there to 123 MW.
And Italy, too.
They also acquired 9 MW of solar projects in Italy, bringing their total targeted capacity in Europe to 92 MW. These are large, calculated investments designed to meet that aggressive 2027 target and secure stable, dollar-denominated revenue.
And significant cash was also injected into their regulated financial services arm.
Yes. They participated in Diatun Bankas's 1.2 billion lira capital increase, injecting over 682 million in cash to maintain their majority stake. It shows an unwavering commitment to scaling up their regulated financial services sector.
Finally, an investment targeting the high-tech automotive segment, which is very different from the car sales business that's struggling.
Right. One of their subsidiaries acquired 25% of Daiichi Electronic, which specializes in automotive infotainment tech, for $15 million. This targets growth in the high-tech components sector, which is less vulnerable to the import tariffs hitting physical vehicle sales. It's a targeted pivot.
We have to revisit those critical footnotes for any retail investor trying to understand this report. The first is that omnipresent TMS 29 impact.
Right. The application of high inflation accounting means every single figure we've cited is restated to the purchasing power of September 30, 2025. This methodology generated that massive non-cash net monetary loss of 4.69 billion lira.
And that's the single biggest factor separating their great operational performance from the final reported net loss.
It is. Investors must look past the net loss and focus on the EBITDA and operating income lines.
There was also a complex dividend decision that investors should understand because it relates to the different sets of accounting records they keep.
This is a complex quirk of Turkish dividend law. The General Assembly approved a substantial 800 million lira gross cash dividend. Critically, this dividend was sourced from extraordinary reserves based on their legal records.
And this happened even though those same legal records showed a net loss for the period.
A net period loss of 1.5 billion lira, yes.
So even with an accounting loss, they paid a large cash dividend. How is that possible?
Companies in a high inflation environment, even when reporting an accounting loss, often have the legal ability to distribute cash from accumulated historical reserves. It ensures shareholder returns stay consistent despite the volatile financial reporting caused by TMS 29.
So it's management signaling confidence.
Confidence in their cash position and operational strength, even when the net income statement looks negative. The payment was finalized on September 1st, confirming that commitment.
After navigating all those numbers, transactions, and the complexity of inflation accounting, let's synthesize how management views the road ahead and what this all means for you, the retail investor.
CEO Shalar Gadoush was very clear in his commentary. He said 2025 and part of 2026 are defined as years of focus, simplification, and consolidation.
So it's not about maximizing short-term revenue right now.
No, it's a deliberate phase to digest recent acquisitions, optimize the portfolio structure, and solidify the operational improvements we've seen in the high-margin sectors.
What is the big long-term prize they are chasing? What metrics should investors be focused on for the next 5 years?
The ultimate target is highly ambitious and, importantly, dollar-denominated, to achieve $4 billion in net asset value, NAD, by 2030.
A USD-based metric is key.
It's key because it bypasses the volatility of Turkish lira profits and inflation accounting. It forces management to measure their success in creating sustainable, internationally recognized shareholder value. It confirms the strategy is about value creation, not maximizing volatile reported net income.
Given the massive regulatory drag on the auto business in Q3, management had to revise its shorter-term 2025 expectations. What was the substance of that revision?
The revision came on August 12th, specifically citing those automotive headwinds. They had to scale back their overall growth targets. The revenue growth target was revised from CPI increase plus 5 to 8 points down to just CPI-like revenue growth.
And the same for operational targets.
Similarly, the FEVA growth target was revised from CPI increase plus 6 to 10 points down to CPI-like FEVA growth. It's an acknowledgement of the short-term difficulty.
But the key is that despite these short-term adjustments, the long-term value creation thesis is still intact.
Absolutely. Critically, management affirmed their long-term value creation goal. The target of a 5% to 10% annual increase in net asset value in USD terms remains fully unchanged. This confirms the short-term adjustments are temporary responses, not a fundamental change in their strategy.
And they maintained high confidence in the segments that are driving that long-term growth.
Yes. The forecasts for their star performers were all maintained at high levels. Renewables still targeting a 78-75% EBITDA margin, mining aiming for a 39% margin, and digital finance for over 70% revenue growth. It signals their confidence that the core pillars can power them toward that long-term goal.
Finally, let's look at how the company is actively supporting its share price, beyond just the dividends.
They're actively engaged in a share buyback program. A new one was launched on April 2nd, specifically to support stable and healthy price formation for Dow shares during this period of transformation.
What are the details of that program?
The program authorized buying a maximum of 50 million shares, with a maximum fund of 1 billion lira, valid until the 2025 AGM.
How much have they bought back so far?
As of September, the group had acquired 4.3 million shares under this new program. It's a consistent, visible effort by management to signal value and provide active support to the stock price. So if we connect all this to the bigger picture, Dozen Holding is undergoing a significant, active, and I would say necessary transformation. They're strategically shedding non-core, lower-margin assets. We saw this with Ditosh and Boybot to finance aggressive, high-margin growth in sectors like renewables and digital finance.
And aiming for dollar-denominated expansion abroad.
Exactly. While the short-term performance is heavily complicated by the automotive issues and inflation accounting, that TMS 29 generating the big non-cash loss, the core operational story is profoundly strong. Consolidated EBIT is up 59% if you exclude the automotive drag. The focus is clearly on achieving that ambitious $4 billion NAV target by 2030, driven by the elite margins of these core global growth segments.
This raises an important question for you to mull over. Given the heavy investment in overseas renewable energy and the maintenance of their $617 million solo net cash position, how durable is Dehill's capital strategy against future inflation spikes? And how successfully can management convince the broader market to ignore the headline net loss in favor of their strong operational EBITDA figures and long-term dollar-denominated goals? Is the market ready to differentiate accounting loss from operational health?
That's the key question.
Thank you for joining us for this financial deep dive. If we helped you untangle the complexity of the net loss from the strong operational EBITDA, then please hit that like button, subscribe to the channel for more detailed analyses, and share this content with your investment networks. Hype it up in the comments and let us know your thoughts on Dehill's aggressive portfolio shift and its potential to hit that $4 billion NAV target. We'll catch you on the next deep dive.